Hi everybody, this is Craig and I want to talk today about interest rates. So if you're thinking of buying a home, or even if you've just seen the news, I'm sure you're aware that interest rates have gone up lately, fairly significantly actually. What you may not know or you may not have a real firm grasp on is exactly how that will affect your payments and what it really means in the big picture. So today in this video, I'd like to dig into that a little bit deeper and also put it into historical context and talk a little bit about what this year's interest rates mean compared to the past. I guarantee there will be one or two things in this video that you didn't already know that will hopefully help you with your decision making, or at least it'll help you impress people at a party or something. So where are we at today? Right now today we're at about 5.8, 5.9%. That's for a 30-year fixed mortgage. That'll apply to most people. Your results may vary. It always depends on your situation and your price range and your amount of money and your credit and all those things. But let's just say the average bear is going to be paying roughly 5.9%. That's up from a year ago about 3%. So in a minute, I'll walk through a couple scenarios of what that might mean for your payment and your finances. But first, let's talk again about what do we mean when we say historic interest rates. Like we've been saying for years that we have historically low interest rates, even though they continue to go down. People say even though they've gone up, they have been historically low. I don't know that anyone's saying that today. But at 4%, they still consider that historically low. So let's take a look. Here's a little graphic that shows the last 50 years of interest rates. So typically us kind of old timers tend to think of something historical as being, something we remember, or at least for interest rates. What do we remember from the past? And you can see mostly we've hovered in that kind of that 6 to 8% range over time. So, if we're at 5.8, you could say that's still historically low. During all that time, people bought and sold homes and did all of that. Now, you'll probably notice that there is a huge spike around the 1980s. You may have known that already, but let's dig into that a little bit deeper. How did that happen? What was the result? So, the big spike in interest rates starting kind of 1979 had a lot to do with inflation, and there was kind of runaway inflation. And then this guy came into the picture. This is Paul Volcker, who at the time was the chairman of the Federal Reserve Bank, or chair of the Fed, they call him. He is seen here actually testifying before Congress, and also reminding us how much has changed in relation to public smoking. So I think he enjoyed a cigar or whatever that is. So Paul Volcker, here's another picture of him accepting the job from Jimmy Carter. And interesting factoid, or at least anecdotal story, is that he came in to interview in the Oval Office with Jimmy Carter, who was president. And he said, I firmly believe that because of this inflation, everything is going up really quickly. There was a big oil embargo, the lines at the gas station, that kind of thing. He said, I believe the way to fix this is to aggressively raise interest rates, make it kind of hurt. It's going to be difficult for a lot of people. And he firmly believed that Carter, being president, would not like that and wouldn't hire him for the job. So presidents tend to not like really high interest rates because everybody suffers and it makes them look bad. So sure enough, a couple things happened. Paul Volcker did get the job. He did raise interest rates very aggressively, up to about 18%, and things improved. Inflation came down. Carter lost re-election because of probably a lot to do with that interest rate situation. Ronald Reagan came into office. Paul Volcker stayed on. The economy improved, and interest rates kind of steadily went down. They've really gone down more or less almost ever since then. So that demonstrates the last 50 years or so of interest rates. But what about before then? Well, I'm glad you asked. Here's another chart that shows the last 200 years of interest rates. And it's a little bit busy. You can pause and read some of the detail if you'd like. But in general, you see that interest rates have still kind of fluctuated between that, 4, 5, 6, 7, 8% range. Now, I will say this chart is actually not the mortgage interest rate. This is kind of the Fed rate that banks use to base mortgage rates on. But generally, it's going to be pretty accurate. So there you see the big spike in 1980 is still by far the biggest spike, even over the last 200 years. The other interesting thing about this chart, it shows you that other times had spikes that were a little more moderate during major events, wars, and that kind of thing. World War II actually saw real low interest rates, so I think the government tried to rebuild the economy after World War II and the Depression by lowering interest rates. But the Great Depression in the 1930s, and then I didn't realize, but there were a couple other depressions, or what they call the Panic of, 1857, and a couple others. There was even a depression back in the late 1700s, which I did not realize. But, the point is, interest rates still kind of have fluctuated in that range ever since then. However, here's the interesting fact, or one of them. A guy by the name of Andy Haldane at the Bank of England, put together a chart showing 5,000 years of interest rates. Here's the chart going all the way back to 3000 BC. Those ancient Mesopotamians were being charged up to 20% interest. So that's when interest was new. And they were a little bit kind of like your loan sharks at the time, saying, hey, if you want money, you're going to have to pay for it. So here's an image of the early Mesopotamians, about 3000 BC, being charged interest. And what were they being charged interest for in those days? Mostly barley. So your craft beers would have been pretty expensive back then as well. But again, you can see, and this I find really interesting, 5,000 years of interest rates, and still the 1980s was the biggest spike ever. So way to go, Paul Volcker. So getting back to what this means for you. So let's say a couple scenarios. Let's say you're a first-time home buyer. You're probably feeling the pain a little bit more than other people because you didn't own a house to see the prices increase. So I feel for you. If you had bought your first house a year ago when we were saying prices are increasing, you would have saved, compared to today, you would have saved some on the value of the house. But the interest rate going from, let's say, 3% roughly in 2021 to almost 6% in 22, that would save you, or will cost you now anywhere from $300 to $500 more per month. So that depends on your price and your down payment and all those things. But that's not unusual. That's probably a pretty good rule of thumb. So that kind of stinks. But as a first-time home buyer, compare that to paying rent. Okay, so if you're paying rent, you're going to be paying more each year. Rents have gone up quite a bit, so you can probably still get a mortgage for the same. If you're renting a house versus buying it, your mortgage payments, I'm guessing, will be less than what you're paying in rent. And those payments go toward your equity, your future, and as the price increases, you will gain equity, sort of like free money, because your house price has gone up. The other thing to remember there, most mortgages now are fixed 30-year. Some do 15, but most mortgages are fixed 30-year. There used to be other products, or some people still do this, called an adjustable rate mortgage. You can get a little bit lower rate, but then it will adjust in 3 to 5 years or whatever. Typically not a good idea. So if you don't already have a lender, find a good lender, talk to them. They are more the experts than us realtors, but you want to kind of look at all of those factors. I would say it is still worth it to go out and house hunt and buy something. So some people are predicting that prices are going to go down and we're going toward crash like in 2008. I firmly don't believe that. I really think prices are going to continue going up, just not as fast as they had been. I do have another video about that topic that goes into a little more detail. I'll put it up here for you. You can watch it after this. Another good thing to keep in mind, even though interest rates have gone up lately, a lot of economists are expecting that they'll come down again in the next couple of years. Don't know for sure, and not everyone agrees. But if you buy something now and you plan to stay in it for at least 5 years, probably 5 to 10 years would be ideal, it would be worth it to refinance in the future. So there is a cost for that, but if interest rates go back down to 3.5% or 4% or something, might be worth it for you to refinance. You can lower that payment, and then again, on a fixed rate mortgage, your payments will never go up. Your rent is definitely going to go up. So think about all that. Keep in mind the big picture of historical rates. We're still in pretty good shape. So that's it for now. Thanks for watching. You can watch my other videos. Like and subscribe. Thanks. Bye-bye.